Well, my next guest expects the euro to fall even further. He says a drop beneath 130 would take what he calls a marquee event, and that's something he doesn't foresee in the near term. Adrian Schmidt is foreign exchange strategist at Lloyds Bank Corporate Markets, joins me in the studio now. Adrian, thanks so much for coming in. So we can see that Italy's credit rating cut is already weighing on euro-dollar, isn't it? What sort of trend are we going to see over the next few months?
Well, the rating cut was largely expected, and to be honest, euro-dollar's bounced nearly a figure this morning since we saw that. I think the issue is, obviously, it's not just about Italy, it's about the whole European debt situation, and there's no real solution that's likely to evolve. It's a very long-term issue. But I think the way things develop, we go from event to event, and the next one, presumably, is going to be the next Greek tranche, which should get awarded in early October.
So the downside pressure is likely to continue in the short term. If and when we do get the next tranche of Greek aid, will that relieve some of that pressure?
Yes, I think so. I think we'll get a little bit of a bounce. It's not a solution, of course, but it kicks the can down the road for a bit longer. And in the end, time is the only thing that solves these issues. So I think the thing you have to look at with the euro-dollar, though, is it's not just about the euro, it's also about the dollar. And over the last year, we've actually seen the euro higher against the dollar despite all these issues, mainly because of US reasons. Coming into November, we've got the US coming into budget discussions.
Yes, exactly.
And those don't look particularly favourable at the moment. Potential QE in the US as well.
That changes the dynamics, doesn't it?
Indeed.
So then what happens should we see? I mean, the big focus this week is the FOMC meeting, isn't it, in the US? So are we likely to get some sign or some commitment to more monetary easing, or is it just too early for that?
Well, I think it's too early to get QE, certainly. Operation Twist is the talk, essentially trying to flatten the curve, which we may get in some form or other. I mean, I think in reality that is in practice going to be pretty ineffective, as it was when they first did it back in the 60s. But I think it will be a signal, if they do an aggressive version, that the Fed may be prepared to do QE further down the road, and consequently will be seen as dollar negative.
All right. So we were just listening to comments there from Luca Salippo of Natixis saying that perhaps the ratings cut wasn't justified given that the government had been pushed into austerity measures, and that is exactly what they've been doing. The Italian government's passed 54 billion euro austerity package. So, I mean, what do you think? Is it justified to have a rating downgrade in the aftermath of these budget-cutting measures?
I think if you look at the rating, it's probably not unreasonable to have the rating where it is. The question is whether it's reasonable to downgrade it on the news that we've had. I think you could arguably say they should have downgraded them a year ago.
So they're behind the curve?
Exactly.
Are they still behind the curve when it comes to
I think in
countries?
practice, the truth is that Italy is very unlikely to default. It's a very rich economy, and the government still has plenty of potential to raise taxes and to raise revenues in general. So I don't think there's necessarily reason to be looking for further downgrades.
So then what would be the marquee event that would potentially push the euro below the 130 mark?
Well, the marquee event, the one I'm talking about, which I don't think is going to happen, would be something along the lines of a Greek default, or the IMF refusing to pay the next tranche, or something along those lines, which of course could cause all sorts of repercussions around Europe. I don't think it will happen.
What is your long-term thinking, Adrian? Because even if Greece gets this next 8 billion euro tranche of aid, it doesn't actually resolve anything. No,
it doesn't resolve anything. The objective is to get Greece into a situation where more restructuring is going to occur and Greece can start to look viable in the longer term. Now, no one believes that they will pay off their debt as it stands without further restructurings. But they're targeting getting to a primary surplus next year. After that, perhaps they'll be looking to actually getting to an actual surplus the year after that. And if you can get to that situation, then Greece is in a situation where it can reduce its debts more significantly. And perhaps then we can see the euro rally.
It's going to be years before we get to that situation.
Oh, absolutely, absolutely. But I think the market will, to some extent, lose patience with being negative. I think once it becomes realised that Germany is essentially going to back Europe, as it became clear in the first ERM crisis in 1995, that's when you get the turn. And I think that's clear to me that Germany, in the end, will see that as the least worst result.
When are they going to see that? How close to the brink of something potentially catastrophic? I mean, that's the sort of language we heard from US Treasury Secretary Tim Geithner over the weekend in Poland. So not my words, but that's the sort of language you've been hearing. How close do they have to get to a tipping point, if you like, before Germany steps in?
Well, I think Germany has stepped in already, but I think the fourth quarter is crucial because we have the FSF coming in, presumably in October, once it gets ratified by all the nations, and then it's a question of whether the FSF is able to shore up the Italian and Spanish bond markets, as the ECB have been doing, without running out of funds. If it does look as if it's running out of funds, will the ECB step in? And then we have the issue about Greece achieving its budget targets in Q4 as well, which it probably won't, and that may be the big issue.
Adrian, just a quick one on the best currency play right now. You're saying the US, the dollar has outperformed, hasn't it?
Yes.
But the fact that it's... How long will it be able to maintain its haven status for, if you like?
Well, I think I'd put the conditions for the dollar to do well in the same way as the euro to do badly. A marquee event really is necessary. The dollar can maybe carry on for another % or so, but I think the upside for the dollar is quite limited because of all the US issues. I think the flow, long-term flow, still continues to be seen out of the US and to be honest, into Europe. So the US will do well in a situation where you have a pure risk-off situation. I think if you're looking for something a bit more that might do better, even if you get a slightly better risk appetite story, you've got to look at Scandinavia, Sweden.
Low deficits, high surpluses.
Indeed.
Right.
Even at this level, you've even got to look at sterling, which has similar characteristics to the US, but has weakened quite a bit in the last month or two.